Every year, Vanguard publishes their forecast of what they think is going to happen in the next few years in the stock market. They also go into details on things like GDP, interest rates, and inflation. Now, this year, from their most recent report, they are making some very interesting predictions about what might happen to the stock market moving forward. And let me just tell you up front that they don't think the next decade is going to be anywhere near as good as the one we've just had. Anyway, let's dive in and see exactly what they're saying so we can get ready for what might be ahead. First up, they talk about interest rates and the impact that these have had on the global economy. They say higher interest rates are here to stay. Even after policy rates recede from their cyclical peaks in the decade ahead, rates will settle at a higher level than we've grown accustomed to since the 2008 global financial crisis. So, in other words, they think that we're not going to go back to the days of cheap money where you could get a mortgage with a 2% rate. Interest rates, as they are now, are going to stay higher for longer, and they think this means that people will invest and spend their money in a different way from the last decade. And that all makes perfect sense. Not only does higher interest rates cost you more when it comes to things like mortgages and loans, but it also costs businesses and governments more as well. So, for example, a new business is going to have to pay a lot more interest than it did a few years ago. And similarly, governments are going to have to be careful how much they borrow too, as their interest payments are going to be a lot higher. Now, what does this mean for us investors? Vanguard say that, I quote, "Borrowing and savings behaviour will reset. Capital will be allocated more judiciously and asset class return expectations will be recalibrated." So, in simple terms, the stock market isn't going to be your only option and you'll have a lot more choice than you did before. For example, right now here in the UK, you can easily get a 5% interest rate on your cash that's virtually fully protected and guaranteed. This makes saving a lot more appealing than it did in just a few years back when interest rates were under 1%. Likewise, this also applies to the professional money managers as well. They can get a return on their money that they hold, maybe in a pension fund, for example, all without taking any kind of risk. Now, what this does, and what Vanguard are hinting at here, is to say that the prices of companies on the stock market may have to come down a bit as they become less attractive when rates are this high. As you can imagine, if you have cash to invest and one option is to save it with a guaranteed rate of 5%, but another is to invest it in the stock market, which has way more risk, you can easily see why that choice becomes a lot harder. Now, although investing can give you much higher returns in the long run, we all know that in any given year, anything can happen. For example, 2022 should be a good reminder of just how unpredictable markets can be. Now, moving on quickly, what does Vanguard think about the stock market and what's ahead? After all, this is what we've been waiting for. Well, there's two parts to this answer, and the first one is they say bonds are back.
Bond.
Yes, your favourite action hero who swans around in tailored suits and fast cars is back to save your portfolio. Okay, well, maybe not that exciting, but you know the ones. Old-fashioned bonds, the things that were meant to protect your investment portfolio from market crashes and give you a bit more stability. Vanguard think that we now expect UK bonds to return a nominal annualised 4.4% to 5.4% over the next decade, compared with the 0.8% to 1.8% annualised returns that we expected before the rate hiking cycle began. I do hope they're right on this one, as bond investors have had a really tough time over the last few years with those interest rates close to zero. If I just quickly get a chart up, you can see this in action. I've got a choice of 3 different bond ETFs here with their total returns for the last 5 years. And then I've also added on the VWRL ETF, which is Vanguard's FTSE All-World Fund. As you can see here, the total bond market and the US bonds have held up a little bit better than UK bonds, shown here in orange. But when compared to investing in the global stock market, they've not done so well. And over the last 5 years at least, stocks have performed significantly better with returns of 70%, which when you annualise that is a figure of 11.28%. Also, don't forget that in 2022, bonds had one of their worst years ever, and they fell just as hard as stocks did. So much for providing downside protection, eh? Vanguard's analysis says 2 things here. Firstly, that they expect the spread between global stocks and bonds to be much tighter moving forward. They say this because they think that US stocks have grown too rich for their valuation, and that the dollar has also strengthened. Moving forward, they see this trend reversing, therefore squashing the returns of stocks and making bonds more attractive. Secondly, they reckon that a traditional 60-40 portfolio, which is one where you have 60% in stocks and 40% in bonds, will finally make a comeback. Now, this could generate returns of 7% a year whilst protecting you a bit more from the volatility that a 100% stock portfolio would typically give you. Now, only time will tell if this ends up being the case, but this would definitely certainly be a big change from what we've been used to in our investing lives. Okay, so that's bonds. Now, what about the big question? What does Vanguard think is going to happen in the stock market over the next 10 years? Let's dive straight into this one, and I'll bring up their predictions on screen now. They've broken down different parts of the stock market and given their opinion on whether they think something is undervalued, fairly valued, or stretched. Now, starting from the top, basically they think that the valuations for most of the stock market is too high right now, with US stocks being the biggest culprit. Alongside this, they even think that UK stocks are also stretched in price a bit, but not by quite as much. On the chart, you can also see how the valuations have changed over the past year and what this has done to their model. The white circles are from their models from just a year ago, and pretty much everything has become a bit more stretched, apart from a couple of exceptions. Now, the areas that they think do have some value to find include two areas, that's emerging markets and US small caps. This isn't a new idea by any means, and I think it's fair to say that many people have been saying this for a very, very long time. The only issue is trying to get the timing right, as those large US stocks, which include the Magnificent Seven, have just been getting more and more powerful. Now, in terms of what this means for actual returns over the next decade, let me just bring you up another part of their research on screen now. This reflects what you've seen on screen before, and you can see that they expect US stocks to only return between 3.3% and 5.3% over the next 10 years. For some perspective, that would be less than half of what they've returned for the last 10 years, which would be an annualized rate of 12%. By all means, the last 10 years have been pretty good and above the very long-term average. But do you think that that means the next 10 years would have to be so poor? Well, Vanguard do at least think there's some green shoots in those areas we mentioned earlier. Emerging markets and pretty much anywhere in the world except the US market, you can see here that they think the most likely scenario is a gain of up to 8.7% a year from global stocks minus the US, and global stocks minus the developed countries. Not great at all then, but let's just remember that this is just a predictive model, and they aren't suggesting that this is what they think will happen. It's all just based on lots of probabilities. And as you should already know, nobody knows the future. Now, after looking at all these predictions about what could happen in the future, I asked myself one question. Can we trust all of the fancy analysis, and does it really matter? And then I thought, hang on, if they do these reports all the time, why don't I go back 10 years and see what they thought back then? After all, surely you can predict what happens in the global stock market more than a decade out, right? Well, lucky for you, I managed to find just the report tucked away from December of 2014. Before we jump into it, let's try and get some context. In 2014, the previous 10 years for investors had been a very bumpy ride because that included the fallout from the global financial crash. The stock market had fallen almost 40% at its lowest point, and interest rates had to be lowered to almost nothing to get the economy moving again. However, even after taking all of that into account, if I do a quick check, I can see that the total US stock market managed to still make a move of 120% over that time, which is a compounded annual growth rate of just over 8%. At the time of writing their 2014 report, the stock market had made a decent recovery and was at new all-time highs, finally hitting the numbers that hadn't been seen since the dot-com bubble. So I wonder, did this mean that they were wildly optimistic or cautious about the future? Let me show you exactly what they thought. Here is word for word what they wrote in their report about their expectations in the global stock market. Simulations for 10-year returns of a global equity portfolio are centered in the 5% to 8% range, a median expectation below the historical average and revised slightly downward from this time last year. See figure 3-7. Now I'll have this on screen looking now as you can see me speaking. This outlook can be attributed to the fact that current market valuations have increased as markets continue to price in a structurally lower growth world with lower interest rates and subdued inflation pressures across the board. When returns are adjusted for inflation, we estimate a 50% likelihood that a global equity portfolio will fail to produce a 5% average real return over the decade between 2014 to 2024. Wow. So that final line there is the real kicker. 5% average real returns over the next decade. So that's your returns minus inflation. If you were an investor in 2014, you would probably be a little annoyed and struggling to think what you were meant to do with your portfolio. You'd have super low interest rates, so saving would be no good, and the experts are predicting that your stocks weren't going to do very well either. Now, funny enough, just like the most recent report, they do say that stock markets outside of the US have a better prospect of doing well. As you can see here, they reckon that global stocks minus US had the chance of doing well and had the best chance of doing well, with their median model suggesting something closer to 9% returns. Now, there's obviously loads more to this report, so I'll try and remember to leave the links in the description if you do want to have a look at this one and go back through history. The point I really wanted to make here was that this report from 2014 couldn't have predicted the chaos of the following 10 years up to today. In the stock market, for example, you already know what's happened up until now. Rather than the predicted returns being poor, they've actually been really good, with total returns over 12% on a compounded basis annually. In fact, over the last 10 years, the US stock market has made a return of more than 210%. Even in real terms, once you take out the high levels of inflation, the markets have done much better than anyone would have also expected. And just think of what we've seen in the last 10 years that nobody could have ever predicted. No amount of running simulations with interest rates, inflation, GDP growth, or corporate profits will give you what we've just been through over the past few years. And I guess this leads us into a bit of a conclusion about what all of this really means for us as investors. So just to be fair to Vanguard, at no point in their report are they trying to suggest that they are somehow gurus and that their models can predict the future with any accuracy. They're just trying to give you some kind of guide as to the probability of what you might want to expect. Imagine if in their report they say something like, stocks are going to the moon, AI is the future, and we reckon the next 10 years are going to be the best investors have ever seen. I don't think that most people would take them very seriously, and they'd get blamed for pushing people into the stock market. Likewise, on the flip side, if they said stocks are all going to crash and everyone should take their money out and only invest in bonds or savings account, I think they'd get a similar reception and be called kind of doom mongers. So I can easily see why they end up somewhere in the middle, and if anything, I do think this is a useful message for investors to remain cautious while also being optimistic about the future. After all, it's much better to have low expectations and then be pleasantly surprised if things turn out better than you expect compared to the other way around. With investing, you really are in this for the long run. There's no shortcuts, and we have to realize that nobody knows anything when it comes to the future. So for me, the conclusion can only really be one thing. As a long-term investor, I don't change anything. I stick with my plans. I keep a well-diversified global portfolio. I keep my costs low, and I consistently invest every single month. No report will be changing my mind, and I think this would be my takeaway message from this video. Pay attention to the experts, absolutely, and take in all of that information. But ultimately, taking any kind of action based on predictions about the future, especially in the financial markets, is just asking for trouble. But hey, just my opinion, and I'm sure you'll let me know what you think in the comments below. Now, as a final note, why don't I leave you with a funny story about making predictions? I think you've earned it for staying this long. In the late 16th century, a German mathematician and astrologer by the name of Johannes Stoeffler, a name I hope I haven't butchered, predicted something that would change the course of many lives. In 1499, he predicted that there would be a huge flood across the world that would consume huge amounts of land. His reasoning behind this was because he said the planets would align to the constellation of Pisces. He predicted that in 1524, on an exact day on February the 20th, this event would cause this flood, as the Pisces star sign is a fish, so that must mean that lots of water was going to fall. Now, Johannes wasn't some mad person making predictions about world-ending events. He was a very prominent individual and even held the position of Chair of Astronomy and Mathematics at the University of Tübingen. Now, as the date drew closer and closer, more and more people got wind of his prediction, and this caused a bit of a panic and a stir not only in Germany, but all over Europe. In fact, it would reach as far as London, where a small fortress was assembled around St. Bartholomew's Church in preparations, and they even stockpiled supplies that would last for 2 months. And when the day finally came, boat builders had been doing a roaring trade, and many people either fled to higher ground or boarded their little small boats stocked with supplies. Now, one prominent count who built a 3-story boat was ready on the day, and crowds had gathered to see what all the fuss was about. Now, nothing much happened during the day, but all of a sudden, rain started coming down from the sky. Nothing like enough to cause a flood, just something like we'd get here normally in Manchester, but panic ensued and the chaos took over. The Count's boat ended up being taken over after he refused to let people on, and he ended up getting himself killed in all the mayhem. The funny part of the story is that 1524 ended up being one of the driest years ever on record. Johannes, clearly not content with getting the timing wrong, said that it would now happen in 1528, pushing back his prediction by 4 years. Safe to say nothing much happened then either, but a lot less people would be paying attention to him by then. That story reminds me a lot about some of the money managers you see on TV and some of the people you might come across here on YouTube. Anyway, stay away from predicting the future, but I do predict that I'll see you in the next video. As always, happy investing.